Hello and welcome to Trusts in Focus. Today we're going to turn the spotlight on Schroder Japan, which has just announced some interesting news about changes to their dividend and discount management policy for investors. To that end, I'm joined by Joe Litschauer, one of our Kepler Trust intelligence analysts, to talk about SJG and the wider sector in more detail. Joe, many thanks for joining us today.
Thank you, Joe. As you mentioned, yes, the board of Schroder Japan have recently announced some really interesting news, actually, off the back of their discussions with some large key stakeholders. And the first part of the announcement details the board's plan to adopt an enhanced dividend policy, where it will aim to pay out 4% of the average net asset value each financial year. The second part is focused more on the discount, and notably, this is a newly proposed conditional tender offer, which will be in effect from the end of July 2024, so this year. More details will naturally come to light in their next annual report, but I think we can go over a few key things today.
Fantastic. So could you start off by talking us through the new dividend policy in a bit more detail?
Yes, absolutely. I think whilst we don't have all of the details yet, we do know that the board is planning, as I mentioned a minute ago, to pay out 4% of the average net asset value in each financial year. As we understand it, this will involve drawing on their ability to pay the dividend from capital. And this means it's relatively unrestricted in its ability to pay that dividend by kind of income generated from that portfolio. In essence, it doesn't really matter if the dividend income rises or falls because it has the support and the ability to pay that dividend from capital. And I think this is key because it means that shareholders have a fairly high degree of certainty that they will receive a dividend of 4% of NAV each year. However, it does mean that the dividend might not be as progressive moving forward. And I think this is because if the NAV falls, the dividend will become lower and therefore not grow. But equally, on the other hand, if the NAV grows, the dividend is likely to grow. So that's just one thing to bear in mind. I think either way, though, an enhanced dividend policy like this means Schroder Japan is much more attractive to investors. And I think that goes for investors looking for exposure to Japan, whether it be a preference to the way Misaki invests, which we'll come on to later, or it's those looking to diversify their income streams or portfolios that are focused more globally. And they want to kind of tether away slightly from the more traditional equity income spaces. And this enhanced dividend policy that the board have announced would, at the time of us speaking, Joe, make Schroder Japan the highest yielding trust in the AIC Japan sector, which I think is another good point towards those looking for a higher income outside of those more traditional areas.
Definitely.
And I think what's really quite interesting is the backdrop. The dividend culture in Japan currently is strengthening. We are seeing corporate governance reforms really being pushed. I mean, they've been ongoing for quite some time, but in the last year or so, there's been a real push here. And it's led to Japanese companies placing a much stronger focus on returning that value to shareholders. And when we talk about returning value to shareholders, it can obviously be done in a number of different ways, but in this case, it's utilizing cash that they typically have hoarded, given they've been in a deflationary environment for so many years, but returning that cash on their balance sheet to shareholders in the form of an increasing dividend, for example. So I think the aim of the board and the announcement they've made is supported by the backdrop in Japan, which provides a bit of kind of weight to it as well. And Misaki, over his tenure, hasn't just started investing in a particular way. He's been doing it across the years. And the backdrop of Japan's increasing dividend focus, his investment approach, and the board's aims to do this dividend policy, I think all work together quite nicely and support one another. And this has enabled Misaki over his time as manager on Schroder Japan to grow the dividend by 12.5% on average over the last decade, which in itself I think is quite a good feat.
Thank you. And turning to the discount policy, could you give us an overview of the changes here?
Yeah, absolutely. So again, following the discussion that the board had with its largest shareholders, it said it would essentially be updating its current tender offer. The current and the existing tender offer they have in place. They brought that in August 2020, and this is about to expire. And essentially, the trust's strong performance over the last 5 years means that Misaki has delivered enough outperformance of the index or the benchmark, which is the topics in this case, for the tender offer that's in place right now not to be triggered if things will continue to go on up until the end of July this year. So the board is now proposing simply a follow-on tender offer on top of that, whereby they want to see the manager sustain that outperformance at least in line with the topics index over the next 5 years from July 2024. If, for example, Misaki was unable to do so and fell below the benchmark over that period, then the board would put to shareholders the proposal to tender offer, and that would be 25% of the issued share capital at a price equal to the prevailing net assets less any costs at the time.
And what are your views on this?
Yeah, it's a great question. I think while we don't have all of the details so far, I do think 25% is quite a meaningful tender offer. I think if we put this in context to other trusts out there, there are some that put a tender offer at yes 25, others put them at 15. Some don't offer anything at all. So I think it is quite a statement and a backing of conviction of the manager's abilities. And the tender offer itself affords shareholders some version of protection if the trust underperforms. It allows them to exit a portion of their investment at NAV if performance disappoints, which, again, in my view, is good. I also think it acts as a bit of a performance incentive for the manager himself. It gives him a bit of motivation to continue showcasing that the process works, that his stock selection abilities as an active manager are good enough to outperform the index, which is what we'd like to expect from an active manager in that space. And as we alluded to earlier, Joe, the performance over the last 5 years has been very, very strong. So it doesn't look like that the current tender offer will be triggered. And I think one of the key backings behind this is the way Misaki has invested, his investment process to the market. I think that's been really, really crucial to the strong performance over the last 5 years. And what he tends to do is he focuses on those high quality investments in Japan that he believes are undervalued. And he also likes to identify those that have particularly attractive growth characteristics and potentially possess the ability to get involved in the longer term trends in Japan, the structural growth trends that will see, the growth prospects really spike over time. And this focus in its entirety does bring with it some valuation sensitivity, which if you were looking at the portfolio stylistically for a moment, you could argue it was more tilted to value. But this is very different from the Japanese sector, which is very growth orientated. Most peers in the sector are kind of growth focused. So in that alone, Schroder Japan stands out amongst its peers. But in our view, I don't think it's fair to say Schroder Japan is an old school, typical Japan strategy. The manager does not go and delve into the deepest, darkest value sectors in the market looking for anything that's cheap. There are certain requirements and characteristics that need to be met before Misaki invests. So I think it's very fair to say that he is a manager who blends the aspects of growth and value together. And I think this has been quite a good approach over the last 5 years, because we've had both value strategies and growth strategies dominate at different periods, and the focus that Misaki has applied to the market has ended up with Schroder Japan topping the table over the last 5 years in terms of performance, and that's the AIC Japan sector, not the smaller companies.
And what do you see as some of the wider implications of these changes?
Yes, another good question, and I think more will naturally come to light as time goes on. We've got an upcoming annual report from Schroder Japan in the next few months, so there will be more information as time ticks on. But I think this kind of announcement, in my personal view, should increase the appeal of the trust. And this, again, is both to existing investors and also potential investors looking to gain that exposure to Japan, but also perhaps tearing away from the more traditional global equity or UK equity income strategies, because Japan has such a difference in culture, in its economy, in the way the stock market works, in the way the companies themselves work, that it genuinely offers a source of diversification. And with the background of, focusing on strengthening dividends, bettering corporate governance practices, essentially enhancing the standards of all Japanese companies in time, offers potentially a really good source of genuinely different returns. And I think that will really appeal to a lot of investors out there. And I think these changes that the board have put forward do underscore a commitment into delivering more of a consistency and more of a competitiveness in terms of returns, as well as aligning their interests with shareholders. I think that's quite key.
And as one of our Japan specialists at Kepler Trust Intelligence, what are your thoughts on the wider sector?
In my personal view, it's a very, very interesting place to invest right now, and I think we could talk for hours about the stuff going on. I think it's the dialogue at the moment is really, really interesting, but we'll keep it a little bit more concise. I think Japan, as a country, as a market, as an economy, has gone through a long period of stagnant growth, and this followed the period where the economic bubble burst, which led to a financial crisis in the years that followed. But I think investors' heads have really started to turn now, particularly given the stock market's recent ascension. And by that, I mean the Nikkei 225, which is probably the more popular and more well-known index in Japan, has surpassed its 1989 highs for the first time, and it reached over 40,000 points in February 2024. And what makes this time, in my view, different to previous periods where the stock market has done well is that there have been a number of factors that have supported this rise. And we can talk to certain companies benefiting from, the weaker yen, giving them a significant earnings boost. We can talk about increased demand coming from China, given their lackluster recovery post-COVID, and even the return of inflation. I know, as we alluded to earlier, that Japan have gone through quite a period of deflation. So they're actually welcoming inflation and referring to it as positive inflation, which is allowing companies to kind of exert their pricing power for the first time in years. So we can talk to all those at length, but I think for me personally, Joe, the most important, or I say the most impactful event that has happened has been the corporate governance reforms. I think they're playing the biggest part. And while they've been ongoing for a good decade, even over Abe's reign as leader of the country, particular progress has been made in the last year or so when the Tokyo Stock Exchange stepped in and essentially ramped up that pressure on Japanese listed companies that were not compliant to certain requirements. And they have put forward very clear-cut requirements on what they need to do in terms of the valuation, so price to book of at least 1, and what they need to do in terms of their growth prospects and corporate value going forward, and that is a return of equity of at least 8%. And essentially, they are committing to publicly naming and shaming those that don't. And as a culture of Japan has for pride, that seems to have really impacted things so far.
Absolutely. And what do you see as the effect of these initiatives on Japanese equities?
Well, I think it's been really strong so far. Clear progress has been made and is underway. Naturally, there are definitely areas that we could see improving. But I think if we're just looking at what's happened so far, the reforms, the focus on returning value to shareholders, just enhancing those standards of companies has really helped push the stock market's price to book upwards. I think the last time that we looked at this, the price to book had climbed to about 1.6, 1.7 times, and that's gone from a region of 1.2. So there is material progress that's been made, which is good. But where I think the opportunity lies is with the pool of companies that have still yet to meet those requirements. So having spoken to a number of Japanese fund managers over the last few months, the general view is circa 1,600 companies across the market have yet to meet those requirements I mentioned earlier with the price to book and the return of equity. And in my mind, if we saw an increase, it doesn't have to be a meaningful increase, but if we saw an increase in the companies yet to meet those requirements, actually meet those requirements, then I think Japan's stock market's got room to run. It could propel the stock market a lot higher, which in turn would mean we're in a fairly early stage of the kind of opportunity set in Japan. And another key point that I think is worth drawing on is that despite Japan reaching a 34-year stock market high, it also remains a lot cheaper than most of its developed market peers, which in my view, again, creates that kind of compelling opportunity and option for investors looking to diversify their global portfolios with sources of differentiated returns, right? So you can probably tell, but my views on Japan at the minute are quite strong. Very excited about the market and country as a whole, and I think the backdrop is very supportive to Masaki's investment process, his philosophy, the way he invests, but also the board's announcements that they've recently made.
And that seems a good point on which to finish for today. If you'd like to find out more information about the Trust, you can head over to the KTI website where you'll find Joe's latest research note, as well as a recent article written by one of our colleagues on the impact of corporate activity in the sector. You can also find in-depth information on SJG on the Schroders website. Thanks to Joe for joining us today,
Thanks very much, Joe.
and we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.